Now, moving on, in this section, you will learn the two prices in the financial markets, not just the forex markets. What is the spread and why it matters, and how to reduce the spread. Okay, so let's get started. The two prices in the market. So here's the thing, right? When you are trading the forex market, the stock market, or any of the financial markets, there is always two prices. So they are number one, the bid. The bid is the price which you can sell at, and the ask. This is the price which you can buy at. So this concept is the same as going to a money changer. Whenever you, let's say for example, you want to buy and sell a certain currency, let's say euro against the USD, you are always being quoted two prices, the bid and the ask. And it's the same concept over here. So let me share with you, and explain what this means. So the bid, right? Let's say for example, if you look at a chart, I'm going to bring up my charts over here. You see, this is the dollar, the USD against the Singapore dollar. This over here is the bid, and this is the ask. So as of right now, if I want to sell the US dollar against the Singapore dollar, I can sell it at 1.34101. And if I want to buy US dollar against the Singapore dollar right now, I will look at this blue box and I can buy it at 1.34115. Make sense? So there's always two prices, right, which is being quoted in the forex market: the bid and the ask. And depending, what you're trying to do, if you're trying to buy, then of course you will pay attention and see what's the asking price. If you're looking to sell, if you're looking to short a currency pair, you will pay attention to what is the bid price. What is the spread? Well, the spread, very simply, is this. Is the difference between the bid and the ask. So let's say, for example, Euro USD is trading at 135.00. This is the bid. And the ask is trading at 135.01. This is the ask. So the difference, right, between the bid and the ask, in this case, is 1 pip. So this is the spread on Euro USD. And now you might be wondering, hey Reno, why does the spread matters, man? What has it got to do with me? Well, a lot, right? It has to do a lot with you and your own trading. And here's why. Spread, right? If you look at it, right, you can look at it in the form of transaction cost. In forex trading, most of you probably don't pay commission to your broker. So your transaction cost is in the form of a spread. So let me explain how this works. So the higher the spread, the higher your transaction cost. And likewise, the lower the spread, the lower your transaction cost. And I'm going to give you an example so you can see what I mean. So let's say you buy one standard lot of Euro USD and the spread is 3 pips. How much does the spread cost you in dollar terms? So as we have discussed earlier, one standard lot is 100,000 units. 100,000 units. And the value per pip is $10. So if your spread is 3 pips, this means, right, the moment you put on a trade, when you trade one standard lot of Euro, this should be USD, I'm not sure why it's I. Okay? When you buy one standard lot of Euro USD, you are immediately down $30 on this trade. That is the cost of the spread in terms of US dollar to you. So, if you think about this, right, what if the spread now is 1 pip? Can you see how much of a difference this makes? If the spread now is 1 pip, the cost to you is just $10. See what I mean by having a wide spread and a tight spread? The higher the spread, the more expensive your transaction cost is going to be. The lower the spread, the cheaper your transaction cost is going to be. So now the question is, how can you reduce the cost of the spread? So one thing to point out is that it's near impossible to tell your broker to give you a tight spread, right? Because it's pretty much fixed and there's nothing you can do about it. But what you can do on your end is this. Focus on major currency pairs. So as mentioned earlier, major currency pairs, these are the most popular currency pairs that are actively traded in the world. And if you look at their spread, right, they are usually smaller, tighter than the other currency pairs like the exotic or even the cross currency pairs. So let me share this with you. You can see over here. I'm going to pull up Trading View. If you look at daily time frame, and in case you guys are wondering, right, this platform is Trading View. It provides charting services in case if you need it. So if you look at Euro USD, you can see what is the spread right now. So for example, the difference between the bid and ask is actually shown over here in this middle. The spread on Euro USD right now is 0.2 pips. If you look at pound dollar, the spread now is about 0.3. It's moving, up and down. Just pay attention to this portion here, about 0.5. And if you look at Aussie against the dollar, it's about 0.23, 0.2 right now. But what if you look at other currency pairs? Maybe you look at something like the cross currency pair like pound New Zealand. The spread here is now 1.2. If you look at something exotic like dollar against the Turkish lira, is 66.3 pips. So you can see, right, if you want to have lower transaction costs, right, focus on major currency pairs. The spreads are usually tighter, usually lower. And Another thing that you can do is to trade the higher time frame, so the cost of your spread is lower in terms of percentage. So let me explain what this means. So let's say you have 1 pip spread with a 5 pips stop loss. If you think about it, right, your spread is 20%, right, of the size of your stop loss. So let's say if your stop loss is 5 pips, your spread is 1 pip, right? The spread as a function of your stop loss eats up about 20% of it. So this means, right, in essence, your stop loss is only 4 pips. If the market moves 4 pips against you, you are going to get stopped out of your trade. On the other hand, if you have a 1 pip spread, but your stop loss is 100 pips, and the reason why you can afford a 100 pip stop loss is because you're trading off the higher time frame. You have a wider stop loss, right? Because you're trading on a higher time frame. In this case, the 1 pip spread is only 1% of the size of your stop loss. So in terms of cost, it's only 1% of the size of your stop loss. So you can see that in a way, right, your spread, right, you're paying, or rather, a percentage of your stop loss is smaller when you have a wider stop loss. And to have a wider stop loss is usually because you are trading off the higher time frame. And if you think about this, if you trade on a 5 minutes chart or a 15 minutes chart, the price action, right, the way the candle moves up and down, right, the range is usually smaller compared to trading off the daily time frame where the range is much larger. So when you are trading off the higher time frame with a larger range, it makes sense to have a wider stop loss to accommodate, right, the larger swings on that time frame. So this is why if you trade off the higher time frame, your stop loss is usually wider, and if your stop loss is wider, you will realize that the spread, right, as a function of your stop loss, right, in terms of percentage is usually lower compared to, let's say you trade off the 1 minute or 5 minutes time frame. The spread as a function of your stop loss, right, is usually wider, and you're going to end up paying more in transaction costs. So let's do a quick recap. Number one, the spread is the difference between the bid and ask. The bid is the price that you can sell at. The ask is the price that you can buy at. Number two, the lower the spread, the lower your transaction costs. And finally, if you want to reduce the cost of the spread, what you can do is to focus on the major currency pairs or trade off the higher time frames.